Hello. Today's film is an examination of the world's youngest major currency, the euro.
We're going to travel back in time and then follow the euro from its launch through the first 6 years of its life. We'll be looking at some of the factors which affected its value over that period of time.
And we're going to use its ups and downs to illustrate some of the key techniques of Western charting.
Charting has its critics. Some say that it's a mere series of coincidences, while others say it's a self-fulfilling prophecy. Our film is an attempt to put charting techniques to the test. You can follow the action and apply the methods by opening Rumus, our technical analysis program. Rumus is available for free from our site www.fxclub.com. The euro is also very interesting because it represents the most recent serious challenge to the US dollar as the world's reserve currency.
So welcome to Charting the Euro, a practical exploration of charting in action.
The euro was launched on January the 1st, 1999. Before then, the European Currency Unit, or ECU, was the accounting unit of the European Union. But at midnight on the 31st of December 1998, the ECU ceased to exist. The euro was born with a value equal to the ECU's final value.
Before we go any further, let's just remind ourselves that price is more likely to rebound off lines and levels of support and resistance than to break through them.
Getting back to 1999, the exchange is opened after the New Year break on January the 4th. We plot the euro's very first resistance line on the chart. We then stick an order to sell at 1.18, a tad below resistance, and we set our stop loss at 1.185.
We'll be discussing the optimum stop loss for different trades throughout this film.
Unfortunately, the trade went against us. Price rose and triggered our stop loss. Only then did the euro start to fall, giving us a double top or perhaps a failure swing. Such is life. That high of 1.19 was the highest high for the next 5 years. Our aim today is to look at the euro's career and learn. Notice how when there's a false breakout of a line, price is held back by the previous resistance level. It happens time and time again, and it's something to watch out for when you're on the market. We can also see here how it's often more useful to view support and resistance as zones rather than strict one-point wide levels.
Meanwhile, the euro searches for new levels.
Is it a coincidence that the euro found its resistance at the 50% correction level of the last move? The support is at 1.1455. Will there be a breakout from it? Let's chart a support zone of 10% of the previous price move, giving us a zone of approximately 50 points. We place our order 25 points above 1.1455 as 1.1480 and a stop loss 25 below the low at 1.1430. The target can be identified with a resistance line or, as you can see in this example, the 38.2% correction level. This gives us a price of 1.1806. We take our zone into consideration and knock off 25 points, giving us a take profit of 1.1780.
Two points on this trade. We are trading against the trend, it's always a riskier option. We manage that risk by setting a tighter stop loss than is usual in day trading.
We move on to trading in the direction of the downtrend. If we place our order to sell here at 1.1780, we need to place the stop loss above the trend line at 1.1875, 95 points from the open, giving price more room to continue its downtrend.
You're always on safer ground when you're trading in the direction of the trend.
And if we miss the chance to get in near the resistance line, the market nearly always gives us a second opportunity. We move from daily to intraday charts, get in on the second chance, and when price takes a breather after a couple of days, we take our profit.
The intraday charts we were using there were 3-hour charts.
3-hour charts give you a good ratio of scope and opportunity. We chart a symmetrical triangle. The triangle fails as price has moved into the final quarter, what I call the no zone in chart analysis 2. We monitor price action and chart another pattern. It's a kind of tapering range which could develop into a triangle. This triangle fails too as breakout came too soon. The important thing here is that price also broke through this support level. Price retests the level, turning it into resistance before heading south, giving us this target. If we'd opened a short position at 1.1525 on the strength of the triangle in progress and had placed a stop loss at 1.1575, where would it have taken us? Crossing over to the day chart, we have a descending triangle, and there's our smaller triangle inside. Remember that all patterns are only fully formed on breakout, and that for all triangles breakout should occur before price enters the no zone, that is the final quarter of the triangle. We've got a breakout on the smaller triangle and then the bigger one. All the signs point to the downtrend continuing rather than a correction. What we should do now is wait. The situation in the former Yugoslavia was becoming increasingly unstable. All the signs pointed to full-scale war in the heart of Europe.
Traders are cautious people, and nothing makes them more cautious than upheaval.
It's the accepted wisdom that in times of war, the cautious approach is to buy the world's main reserve currency, the US dollar. Let's get back to the charts. We're going to use the 2-day rule to confirm the breakout. Remember, this rule says that price needs to close beyond the level for 2 days before breakout is confirmed. There you go. And then price continues its fall and breaks through a 2-year-old support. Further confirmation of the downtrend.
Always remember that whatever happens on the currency market happens as a result of a number of factors.
Nobody would blame us for taking our profit where these two downtrend channel lines cross at point A. That's at 1.0950. This earns us 600 points over 22 days. If we add those 600 to the 200 or 300 we made earlier, we've earned 900 points since the beginning of the year.
It's sound to get out while the going is good. The next question is how to get in again.
Theory suggests that point A marks the level where the trend will correct itself. However, opening a buy position here is a high-risk affair. Our descending triangle had told us that price should continue to fall to a target level of around 1.05. So by buying, we are trading against the trend. And if we're going to do that, we're going to do it very carefully indeed. We're going to use the intraday charts where we can use small stop losses and reduce the risk.
We need to use what the day chart told us while we're working intraday.
So we take the trend lines and support and resistance levels that we identified on the day chart and we look for a correction when price reaches point A. Onto the 3-hour chart, things become clearer. Price slows down and moves between easy to spot support and resistance zones. We work calmly and methodically within this trading range. Breakout on the support gives us target H. This pattern could also be identified as double top or a rectangle. Notice this downtrend resistance line. See how it's narrowing the channel, giving us the makings of a wedge. We know from our previous work on chart analysis that the wedge points to a breakout against the slant of the wedge. We've got a falling wedge here, so we should have expected this upside breakout.
For more information about trading in ranges and channels, see our film Chart Analysis 1.
What we need to do now is work out where we think the correction will end and the euro will continue to fall. The resistance level, which has already proved its worth to us, turns out to be the target of the wedge. The wedge also provides us with a new support zone. Both zones have a width of 30 points. Let's get back to the day chart. How are things developing? The consolidation zone is well defined here and looks like a flag. Flags are often found in the middle of a move, which would give us a target of 1.02. But fools rush in, and we're going to monitor the situation by charting speed lines.
We first talked about speed lines in our film Chart Analysis 2. Speed lines were first introduced by the legendary trader W.D. Gann.
Gann suggested dividing the height of the trend into eighths and using these levels to chart the lines. We're using speed lines generated by Rumus, and we plot them by clicking the Fibonacci fan symbol on the toolbar. Our lines have the default values of 0.382, 0.487 and 0.618. These modified values reflect the Fibonacci series, and we find that they subtly improve the accuracy of your forecast. Sometimes we use 5 speed lines, which are set by adding the values 0.236 and 0.146 to the default values. Notice how the intersection of the speed line and the resistance level gives us the point where the correction ends.
So, we open our short position there. Price falls, breaks through the support, and then retests the line as resistance.
This pause continues for a week or so, and in the absence of any further signals for the downtrend continuation, the most reasonable thing to do is to close the position and review the situation on the intraday chart. Let's project the broken support downwards and use Rumus's Fibonacci retracement levels as a framework. There's our take profit, Now, we were on the market for 2 weeks and we only made 300 points, and we could have got out on the 8th day with the same result. Still, nothing ventured, nothing gained. Notice how price is moving much more quickly in the direction of the trend and much more slowly on any correction. Back to the day chart, and here is our entry point, slap bang on the retracement level. Euro continues its fall, and now we're cooking on gas. We plot a new trend line, speed lines, and we should also add the channel line. As you can see, the trend line and one of the speed lines superimpose. Our resistance zone is no bigger than 40 points, which gives us our stop loss. May to June 1999 saw a steady decline in the euro, allowing us to open and close positions using triangles as our guide. Price hit strong support here, but we could go short at B, where the trend line and the support and resistance lines cross. Another triangle tells us when to close this position. We finish at C. If you take a look at the day chart, you can see that point C lies on the channel line. If you had opened and closed positions as dynamically as this, you would have earned 570 points in a month. If you'd held a short position open throughout the period whilst trailing your stop loss from A to C, you would have made 540 points. The choice is yours. It's a question of style. We finish at C because our chart analysis has suggested that C is where we can expect a turnaround.
But when will it happen? If our forecast is sound, the chart should be able to give us an idea.
We chart a level here and a second here. Drop a channel line from the trend line. Price punches through this trend line and the higher level forms resistance. A second parallel line from the trend line offers a guide. We get a false breakout on a long-term trend line from the daily chart. Here's a rectangle, then a wedge leads us to the channel line with price finding support at 1.01 to 1.0120 over the week. On this 3-hour chart, all breakouts are confirmed by closing prices, so there's no need to rush into opening or closing a position.
More haste, less profit.
We go short at the upper level of the range, anticipating the rebound. Price continues its rise, triggering our stop loss. It's only 20 points, we can afford it. On July 19th, 1999, we had 15 hours to buy euro, from the time it entered the zone to the time we bought at 1.0140. The stop loss was set at 1.0100 at the lower level of the zone. This might seem like a run-of-the-mill trade, but cast your mind back to the flag, which initially gave us the target of 1.01 to 1.02. Admittedly, it wasn't a perfect flag. The flagpole was bent, but all the same it was right on target. We can chart a long-term channel line with a zone of 100 points. Price moved 2,300 points in this channel, and the range in the channel was around 770 points.
The tools we are using here are well tried and tested and were developed by traders over 80 years ago.
All the signs are there. There's already been a breakout of this narrowing channel. When we chart speed lines, we can see that one of the speed lines superimposes the trend line, always a good signal for reversal. This is confirmed with a strong move up and a breakout of the trend line. This is how an ordinary trade can become extraordinary. price reaches the long-term resistance line of 1.0722. Using our charting techniques, we would have opened either at 1.0140 or 1.0270, giving us a minimum profit of 430 points over 6 days.
And it's all down to chart analysis and a little time travel trickery. Meanwhile, out in the real world, NATO has occupied Kosovo.
We go short at the long-term resistance line, the trend line of the downtrend. We are simply obeying the accepted wisdom of chart analysis, but our stop loss is triggered. Long-term trend lines are rarely breached, so we go short another 2 times, each time triggering the stop loss. What's going on? Let's re-evaluate the situation. We plot Fibonacci retracement levels on the day chart using the high of December the 14th, 98 and our low of July 13th, 99. Price has reached the 38% level. We plot speed lines using the same low and the high of October the 8th, 98, and we find one in the vicinity. We check the situation on the weekly chart and find that this speed line is supported by 2 pivot points. A final guide is this resistance level here. We've put in a sell order below the retracement level at 1.08 and our stop loss is above the speed line at around 1.0870 to 1.0880. What happened was that price broke through the retracement level by some 11 points and was 30 points short of the speed line. Price had taken 13 days to reach this local high, and the next 10 saw a 50% correction. Notice how we use the price channel, Fibonacci retracement levels and speed lines to identify turning points. Wave analysis teaches us that a corrective wave has 3 movements, and they are easily seen on the weekly chart. Our film on wave analysis will be released next year. Plot this channel line as parallel to this earlier support. We're going to monitor the next move down from this high on the 3-hour chart. Notice the 2 well-defined channels. 2 reversal points are marked A and C. And reversal point B is the point where the speed line and the 30-point resistance zone intersect. The trend line is plotted through 3 pivot points, ignoring the false breakout in the middle.
So what pattern are we left with after this period of consolidation?
Is it a flag, a pennant, or some sort of triangle? Truth be told, I'm not sure. What's in a name? It's got the makings of a pennant, but it's much bigger. Let's use it to forecast new support now that price is at parity with the US dollar. We forecast support in the region of 0.91. What's more, if everything goes according to the rules, the average speed of this second fall should be roughly equal to the first. Let's see what happens. Here we are on the day chart. A line parallel to this channel line has served as good support and resistance, and this parallel line from point A has provided support for a couple of weeks. We have a good rally, so let's plot a new line here as a possible line of resistance. Point A is very close to the old trend line, which was broken some time back. This point, point B, is only 8 points short of this line parallel to that old trend line. At this moment, our possible new resistance has no confirmation. but a few days later and the resistance is retested. It looks like point C marks a failure swing. Of course, it's easy to spot with hindsight. The sell order should be placed around 30 to 35 points below the resistance line, with the stop loss being placed about 35 points above it, limiting our risk to 70 points.
A larger stop loss reflects higher expectations. So what do we get?
Three weeks after opening this short position, price closes in on our channel line zone, meaning that it's time to close the position, earning us more than 600 points in the process. However, if we were monitoring the move on the intraday chart, we would feel much less certain of our trade. Look, as the euro nears the all-time low of 0.9995, nerves fray and the move falters. An expanding triangle forms, followed by a descending triangle. Both signal uncertainty, and price ranges over 150 points in 3 days. However, the level of support is clearly defined, and the breakout of it takes us towards our target. We project a double channel from the broken channel line, which gives the level where price pauses and a correction begins. We chart the correction using Fibonacci retracement levels, and we find the correction ends at point X.
So we wait a few days while the correction hits the 62% level. What then?
Well, there are a couple of ways forward here. Chart a channel line on the correction, and we see that the channel line and the former support intersect. Open a short position at around the close on February the 23rd, 2000 at 1.0028 with a stop loss at 1.0150 above the correction level and the trend line. A riskier trade would be to place an order to buy on the bounce from the lower channel line with a tight stop loss. The stop loss in this case would be done, and your option would be to go short here. Both tactics would find you taking profit at the channel line.
It just goes to show that you have to think very, very carefully before trading against the trend. The risk is higher, yet the rewards are more limited. In this case, you'd have earned at the maximum 250 points in 24 hours.
After a fall of 700 pips in 4 days, the market moves into a range for 6 weeks. Resistance forms along the Fibonacci retracement level, and here's the support. The range developed into a descending triangle with a bearish breakout. The target of the triangle points to a further all-time low for the euro. However, using double channel lines we can fine-tune the target, and this was reached some 13 days later.
Here is the same period on our intraday chart.
It's a good illustration of how the trend is made up of a series of ranges. Exploiting these ranges would bring us a steady 600 points.
I want to stay on the intraday chart to identify the optimum time for getting back onto the market.
We plot the downtrend on our intraday chart, taking our highs from the 17th and the 24th of April. We plot a parallel channel line using the low of May the 4th, giving us a price fluctuation within the channel of almost 100 points. Once price breaks through the trend line, we drop retracement levels using the max of March the 27th and our low of May the 4th. Price corrects at 38% on May the 12th. We plot speed lines from the high of April the 17th, still using our low of May the 4th. Price bottoms out on May the 19th, giving us a double bottom. Price pushes up through our speed lines to form a double top, maxing late June the 8th and June the 19th. We then plot speed lines using the low of May the 19th and the high of June the 19th. Price breaks out of the third line on July the 12th. We plot Fibonacci retracement levels using our double top and the May 19th low and see price retracing on July the 19th at 62%. The level which offered support in early May now acts as resistance on July the 26th. We plot our downtrend line using the three highs and then a parallel channel line using the low of June the 26th. The channel line supports the euro on the lows of August the 3rd and 9th, while the rally found resistance on August the 16th to 18th at our 62% retracement level. September the 6th saw a breakout of support, last retested on May 19th. We set the target of the breakout using H, which price meets on September the 20th. The move up ends at our downtrend line on September the 22nd and then falls to form what some might call an inverted saucer. After charting a downtrend line using the highs of October the 8th, 1998 and October the 15th, 1999, we can chart a channel line which is confirmed once again by the low of October the 26th at point A. Notice how point A also completes a measured move.
We should always be keeping our eyes peeled for reversal patterns.
This is where experience comes into its own. A position is opened here with a hefty stop loss of 150 points placed here below the expected right shoulder. All on the hunch, yes, the hunch, that the breakout of the neckline will complete an inverted head and shoulders. We should gauge the pattern's importance by the length of time the pattern took to form and where its target will take us. You see, the target punches through this long-term resistance line, but the time it took for the reversal pattern to form compared to the life of the downtrend tells us that we are only looking at a correction and not a trend reversal. The weekly chart provides us with pivot points and a possible reversal point. We plot the retracement levels and speed lines as we have done so many times before. Even if we did not act on our hunch and opened after the neckline breakout, we would have made a tidy little profit on the trade.
So 2001 started with a bang, worth 800 points.
The day chart illustrates how down moves are weakening and up moves are strengthening. This suggests that the downtrend could well be losing its power and price could be moving into a range. We've been charting the euro for more than 2 years now, so moving from the daily chart to the intraday chart near the reversal point should have become second nature.
The move into consolidation is a gradual process, and we'll monitor it on the intraday chart using the lines and levels from the day chart as our guidelines.
Price retraced through the speed lines and finds support at 50%. The dotted line is the long-term trend line. Price then breaks through the channel line and corrects at 62%. It's easy to identify the support and resistance levels, the channel line and the rectangle. From the top of the 3-hourly chart, we've used Fibonacci retracement levels, the double top, the wedge or something very similar to it, a rectangle, channel lines, the double bottom, work with levels and an inverted head and shoulders with neckline breakout.
That's a lot of quality practice, and we all know what practice makes.
The trend line breakout took place after a broadening formation formed on the daily chart. It took 2 months to form on a downtrend that had lasted 6 months, a promising ratio. We plot price target and the price moves into an up channel. I'm sure there's no need to tell you about where you should have opened your position.
Chart analysis is truly an art. In my experience, it's indispensable when we're thinking about future price direction, but sometimes price target is well out.
And that's how that vigorous correction ended. Take a look at it through the framework of Fibonacci retracement levels. But how could we have foreseen that turning point? Price didn't make it to either the speed line or the local trend line, meaning the techniques used so far in this film could not help us here. We've got the makings of a triangle here, and you will have to prepare yourself for this situation when you're working inside triangles like this. What you do is use the double channel tool that you can find on the Rumus toolbar and chart it on the old trend line. There you go.
Another coincidence, no doubt. If only we'd known a triangle was forming beforehand.
Let's continue to monitor reversals on the intraday chart from September 2001. Here's a rectangle and an almost perfect downtrend channel. We plot a 5-line fan using Gann values and then fresh retracement levels which are confirmed beautifully. Remember that a triangle needs 4 reversal points before it can be plotted. We believe that with symmetrical triangles, the angles of incline for support and resistance should be equal. Therefore, once we've seen reversal at A and we've checked that the angles coincide, we can confidently plot the reversal at B. It's not quite a triangle, but who lives in a perfect world?
You can see that there's going to be a slight problem here plotting support.
Which is the correct level of support? Is it this one or this one? The best advice here is to go with the majority and plot a line that connects the most lows. We can assume that the reversal will happen at point P, but we must remember the lower line and take this 100 points into account.
Why are we so interested in this reversal point?
Take another look at the triangle. Price is moving into the breakout phase. If you've seen chart analysis 2, you'll remember that triangles chart uncertainty. The market hasn't decided which way to go.
We are waiting for breakout because only breakout can confirm a pattern. At the same time, all chartists should have a grasp of the fundamentals, and we definitely need to keep an eye on the interest rates.
The Fed had been reducing interest rates since the end of 2000. this was making the US dollar increasingly less attractive in relation to other currencies. Coupled with this, the US budget deficit was beginning to be viewed as a serious problem. The culmination was a sell-off of the dollar. Warren Buffett got into currency trading at this point by going long on the euro against the dollar to the tune of $12 billion, which bought him 13.6 billion euros, a trade that he did not make public until some 2 years later in 2004.
Traders without access to billions needed to profit from the price channel.
All you need to do is keep your eyes on the charts. Check the support. How many times has price bounced off it? 4 at least. It's a gift.
The fundamental economic data is pointing to an upturn in the euro, but the wise trader should proceed with caution.
We know a clean breakout of a long-term trend is rare, and the circumspect approach is to see how the charts confirm the fundamentals. This double channel line points to an upside breakout of the triangle, and this double channel on the long-term downtrend targets a level above the triangle's resistance up to the end of May 2002. So let's move in. We chart a resistance line noting the false breakout. The green line charts monthly support. Notice the long-term speed line which has served us so well in the past. Let's zoom in on the action. Of course, not everyone would have gone long at point A. A lot of us would have been tempted to go short here or here, earning us a couple of stop losses. Some of us would have gone long at the reversal point here, and I'm sure the rest of us would be in after this flag's confirmation that the euro was on the up. The flag's mast gives us our target. Let's just take a look at the big triangle target. It'll take us to around 1.04. That's up from 0.9150. Of course, a big jump like that will necessarily involve some corrections on the way. There's a speed line ahead, part of a sequence which has already proved very useful. And we've also got a strong resistance level at 0.96. The way forward here is to enter the market using the breakouts we identified on the day charts, and to take profit at the potential reversal points identified on the intraday charts. So we take profit at the triangle resistance line, the resistance level at B, and the channel line at A. This strategy would trigger a few stop losses on the way, but all in all would earn us 800 points. Of course, no competent techie would rely solely on charting. He would use this analysis in conjunction with technical indicators, wave analysis and candlestick signals. You can find out more in our films The Essential Indicators, Understanding Japanese Candlesticks, and our forthcoming film on wave analysis.
I can't overstate how important intraday charts are for the trader who wants to be on the market most of the time. The next sequence of charts are day charts, but if you follow the action on intraday charts using the lines and levels outlined on the day charts, you'll see many opportunities to open and close positions.
On the day chart, the 3-month rise is followed by a 4-month correction. The first level here is the former resistance zone, which now offers support. We plot speed lines. We identify these levels and channels, and these two. Point A marks the entry point to capitalise on a continuing uptrend. And here's your take profit, where the two channels cross, giving us a strong signal for reversal. Later, at the 62% retracement level, price bottoms out at a possible entry point. Prices continue to rise and close at the end of the day above the resistance level, giving us another signal to go long. And the task of establishing the optimum level to close, which price reaches on January the 27th, 2003.
At this time, in the real world, the coalition of the willing are preparing for the incursion into Iraq, a full-scale military operation that's bound to have far-reaching economic and political consequences. The thing is that everyone knows that it's going to start, but nobody knows how it will finish.
Take a look at this consolidation pattern made up of two pairs of parallel support and resistance. Let's chart a further line of support and resistance inside the consolidation pattern. Please note the two reversal days that confirm our lines. We enter the market after breakout with our stop loss below support. There's a strong move up and we close when price hits the double channel line, resulting in 600 points in 4 weeks. A double top forms at the double channel line. You can crank up the profit and plot the reversal level at the same time by opening a position either at point A or point B. The correction begins and moves into a narrowing channel. This then retraces to a little over 50% to the zone of the old resistance line and then gives us a double bottom. Price, in fact, breaks through the double bottom support and we can chart an imperfect measured move. We plot a trend line from the low of the move in September 2003 to the second top and chart a Fibonacci fan. This identifies point A as the start of a price rise and our entry point. Take profit when price reaches its new top. Just take a look at how price gaps between the 22nd and 23rd of September after breaking out of the fan line projected from the second top. A price gap on the Forex market is a pretty rare event.
So, we're looking at 950 points in 2 months. But how can we iron out the ifs, buts and maybes?
Once again, we monitor the situation on our intraday time frame. The second top of the double top gives us a strong signal to sell. When the correction ends, we've got to get back on the market with a long position. The big challenge here would have been holding this position open through this resistance zone. The channel line gives us an appropriate target to take profit, and it's time to spot the downturn.
Once again, double tops and bottoms come to our aid.
The support line here is an appropriate target. Although it takes 3 months to reach it, you don't need to wait that long to take some profit. Once again, we focus on the intraday chart and use the support and resistance charted on the daily. Our method here is as before. Here we plot a Fibonacci fan using the double top as our reference point. At this point, I'd just like to draw your attention to our two corrections here. They are the same length and have the same incline. These phenomena will be explored in depth in our film on wave analysis.
We're now looking at April 2004. It was in March of this year that Warren Buffett told the world about his first foray into Forex.
If he had closed his long position on the euro early in 2004, his 13.6 billion euro would have bought him $17 billion minimum.
That's a cool 5 billion profit in 2 years.
The next consolidation period lasted some 10 months. Here's a brief resume of the important milestones of this time. Price falls to a double bottom and then forms a descending triangle. We use a Fibonacci fan to monitor the move as the triangle smoothly morphs into a rectangle. The breakout of the rectangle sees price moving up in a channel, with our target being set with the help of this gentler channel line.
It's January 2005. Our 6-year mission is over. It's time to take stock and sum up what we've done today.
What we have covered today could not be described as a comprehensive trading system. Too many elements are missing. We've looked at various ways to identify when to open and close and when to go long or short. We've also looked at how to plot and work with channels and speed lines. We've set price targets. We have seen the benefits of using more than one time frame in our analysis and of using support and resistance from longer time frames to guide our work on shorter period charts. We've seen how long a reversal pattern took to form can influence the move on breakout. We've also looked at the roles of correction levels and support and resistance levels. We've discussed how trend lines do not disappear without a trace and still have an influence even when we've forgotten about them. We've also witnessed many chart patterns in the field and we've analysed them. This is chart analysis.
We've learned how external factors can influence the market, and we've seen that for some, Forex trading can be very profitable indeed.
One further point. We've used intraday and daily charts in tandem. We monitored open positions primarily on intraday charts, using the lines and levels that we had identified on the day charts.
I hope that this short practical film proves useful to you in your day-to-day trading. Don't forget, you can contact me anytime at fxc@fxclub.com. So I'll say goodbye, take care now and trade well.